One of the hottest stocks in 2020 was DraftKings. The company came public, and then during the pandemic, we had both the momentum of people wanting to do things more like gambling at home and a number of states adding online betting, which opened a bigger and bigger addressable market. Now, the company has been on an absolute growth tear since then and has actually recovered really nicely, currently trading at about $36 per share and up over 230% year to date. But is this a stock to buy now? Are we at the beginning of a growth trend and an improvement on the bottom line for DraftKings? Or is this a pop just because the market has had a really good year? That's what I want to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I want to just show a few charts that I think tell the story well for DraftKings. The first is their revenue chart, and you can see that revenue has just grown like a rocket over the last few years. $323 million in revenue in 2019, and then that jumps all the way to $3.3 billion over the last 12 months. So there's no question that this is absolutely a growth company. But the challenge for DraftKings has always been turning that growth into profits on the bottom line. So I want to add a few segments to this, and this will hopefully give a better picture of what margins and ultimate profitability look like. The blue column is DraftKings gross profit. So this would be the profit that they make from betting before you're spending money on sales and marketing. That's something that DraftKings obviously spends a lot of money on, is sales and marketing. So the company is profitable on a gross basis. But if you look at operating income, that's where you start to get a little bit more concerned. That's what the light orange column is. And you can see that that is negative, and it's not only negative, but has been consistently negative since the company went public. And what is the reason for that? Well, the simple reason is the company spends more on sales, general, and administrative expenses than it generates in gross profit. And it does so by a really wide margin. And these expenses have been consistent over the years. Going back to December 2020, we have sales, general, and administrative expenses of $329 million. In the most recent quarter, those expenses were $443 million. So we're not getting a lot of what we call operating leverage on the growth in revenue. That means that DraftKings is actually having to spend a lot of money to acquire new customers. And that's fundamentally the problem with the business. Yes, you can grow revenue a ton, but if those customers do not have positive long-term value for the company and for investors, then ultimately you're just going to keep burning through money. The other big expense they have is R&D, or product development expenses. And that has been pretty consistent at around $80 to $90 million. In the last 12 months, in the last quarter, that was $89 million spent on that. And that's something that's just going to have to be ongoing, because they're going to have to continue improving their app, their technology, and keeping up with competitors. So that is fundamentally an expense that's going to need to maintain, and gross profit is going to have to cover that expense as well. So I'm going to pull this back up again, but here I think is fundamentally the problem with DraftKings is that they've shown that they can grow, but they have not shown the ability to grow profitably. And what is ultimately going to change that? And that's what I want to get into next. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The challenge with online gambling is it's fundamentally a customer acquisition business. You have to acquire customers and then induce them to start spending money or betting on your platform. And there are a number of different platforms doing this. Depending on where you visit online or the podcasts you listen to, you could hear ads for DraftKings or FanDuel. MGM Resorts is another big player with BetMGM, and there are dozens of other companies as well that have local ties or other brand ties. So this is a very, very competitive market, and a lot of those deals are ultimately cash back or money that you're actually going to get. So the company that's doing the advertising, DraftKings in this case, is going to spend money not only to place the ad, but also the thing that they're advertising, that $100 free bet, is going to be an expense on top of that. So it's kind of like a double expense when you have a business like that. And the problem with that would be fine if these customers had a lot of value long-term, if they were buying some sort of subscription that you could predict that they're going to last for 12 months and they're going to spend $200, so it's worth spending $100 to acquire each of these customers. The problem is betting is not a recurring revenue business. Yes, people can reload. Yes, they can get used to using one app. But if they find that another app is giving them better odds, that's just a click away. So I think this is fundamental. This is the problem that DraftKings and a lot of other companies are running into, is the recurring revenue is not as high margins as they maybe hoped it would be. And when you're getting customers in the door with things like free bets or really good odds on a single bet, they're going to continue looking for those deals. And that's ultimately going to hurt your margins. So you got to be able to cut back on sales and marketing expenses and general administrative expenses. But what's the problem with that? Well, then those customers aren't coming in the door, and then you don't have the same revenue growth. So it's really a catch-22 for DraftKings, because you need to spend the money to be able to attract customers. You need those inducements to be able to get them to make their first bet, but you don't have a business that's fundamentally sticky in the long term and generates a lot of recurring revenue. This is why I think something like online gambling belongs more with a company that can have more real world rewards for customers. So companies like Caesars Entertainment or MGM Resorts that have casinos all over the country and all over the world, they're going to be able to provide free stays or free drinks when you go to the hotel, depending on what your online gambling is like. DraftKings just simply doesn't have that. They don't have that same ability because they don't have those same physical ties. And so that's why I think we're seeing better financial results from companies like MGM Resorts and BetMGM, which they own 50% of that property. But it doesn't have to be a loss leader. They aren't forced to make money there because they have a profitable business with their traditional casinos. So is DraftKings ultimately a buy? Well, looking at some of their valuation metrics, I think the clear answer is no. Price to earnings ratio is obviously negative. It's expected to be negative again next year. So analysts are not expecting a profitable year from DraftKings. But the price to sales, the enterprise value to sales ratio is astronomically high, 5.2. You can get a very profitable tech stock like Alphabet for an enterprise value of 5 times sales. So as investors, I think this is the time where gambling is a great business if you are one of the casinos in Las Vegas or Macau or Singapore. But online gambling has not proven to be a profitable business. DraftKings is a perfect example of that. That's why I am not betting on this stock, despite the fact that it's had a phenomenal year. I think there's going to be a lot of pressure ahead for DraftKings. There's going to be more and more competition. These companies that have a physical infrastructure have a big advantage in the market. And I don't think the future is bright for DraftKings. But what do you think? Do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.